Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Hey, welcome back to Big Money Real Estate. I'm Elise Glenn. Thanks for watching today. CoreLogic has just put out its negative equity report for the first quarter of 2015. So I thought it would be a good time to chat with my good friend, Frank Nothaft again. He's CoreLogic's Senior Vice President and Chief Economist, and I wanted to get his perspective on the housing market and just overall on the economy. So I'm going to start off by getting his take on negative equity trends, and then we're going to seg, I hope, into a discussion that'll touch on some really other important topics like jobs. Frank, welcome back to Big Money Real Estate.
Thanks for having me, Elise.
It's great to have you be here with me. So let's talk about the CoreLogic negative equity report. What did you find?
Well, we found some good news, namely that the number of households that have negative equity reduced over the past year. In fact, it was down 1.2 million households. So that's good news. The flip side of the coin is that there are still 10% of homeowners with a mortgage, or in other words, about 5 million homeowners who still remain underwater. Now, we expect house prices to continue to rise over the course of the next 12 months. We expect about a 5% appreciation in homes across the U.S. And if that happens, that'll help to lift another 1 million of those underwater homeowners and place them right side up a year from now.
All right, so let me jump in and just ask you some questions about that, because a 5% increase in home valuations, when home valuations are already at pretty much the top that they've been at, you know, and homes typically appreciate at a rate just above inflation, and we have like zero inflation out there. How do you get to 5%? And is that 5% distributed equally? Or really because places in New York are now on the market for $500 million?
Well, it would be nice if it was distributed evenly, but it certainly isn't. There are some markets that are a lot more hot than other markets. You mentioned Manhattan and the New York City area. That's one of the hot markets right now. Another one is San Francisco, and actually a lot of the Pacific Coast. That's all very hot too. And there are other parts of the market that probably are cooling off, such as those are markets that have a lot of energy-related production employment. Those markets are probably going to cool off over the course of the next year unless we see a turnaround in energy prices. So it's not going to be a uniform 5% appreciation.
All right.
The reason I think that prices will continue to rise is that we do see markets very tight, very lean supply of homes for sale in markets around the country, and that provides a necessary ingredient for helping to support further house price gains. And even with the gains we've seen so far, house prices in the national index are still close to 10% down from where they were at the peak in 2006. So I think there's a little bit more room for prices to go up.
But to be fair, that whole peak market in 2006, and I understand that was 9 years ago, was sort of artificially inflated. I mean, we reached those prices because people were getting mortgages with like nothing down. They were inflating. There was a whole lot of mortgage fraud going on. It wasn't, there's some people who feel like it should never have been even close to that.
Well, and I agree with that. But even with the inflation that we've had, and it's been moderate, very moderate inflation over the last 9 years, house prices adjusted for inflation are probably still about 30% below where they were in 2006. So they're down about 10% in nominal terms. But once you account for inflation that we've had over the last 9 years or so, they're down by almost 30% in real terms. So I think there is room for prices still to go a bit higher.
How do prices, in your mind, tie directly to jobs and what's going on there? When you don't see middle income or median income really move in 20 years, other than mortgage interest rates being, you know, incredibly low at near historic lows, I would say they're always, you know, just kind of touching that rate. You know, aside from mortgage interest rates being low, if median income isn't changing, how does that correlate into continually rising home prices?
Well, you point out one of the important headwinds that's holding back further progress in the housing recovery. While the labor market has improved over the last few years, and in fact in the last year has created 3 million new jobs in the U.S. economy, there's still a lot of discouraged workers who have not come back into the workforce. So there are different metrics on the health of the labor market. One of them is the unemployment rate. That's down to 5.5% nationwide. That looks like a good figure, and it is a good figure. We have produced 3 million jobs over the last year. Unfortunately, there's still a lot of people who are discouraged workers, have not come back into the workforce. So if you look at a broader measure of labor underutilization in the US, that figure is above 10% of the workforce is not utilized fully. Now, that includes discouraged workers, people who are forced to take part-time jobs because they can't find full-time work. So there's no question that one of the things that has been holding back the housing recovery the last few years is the sluggish pace of recovery in the labor market, and that is a headwind.
So this larger thing that you're talking about, the larger unemployment rate of 10%, that's what is normally called the U6, right? So the broader measure of unemployment?
That's correct.
So when you look at that number, which is somewhere between 10 and 11%, and you look at how many people are out of the job market that should be working but aren't working, how do you feel that the pricing will continue? I know I've asked you this, I'm going to ask you just in a little bit of a different way, but if the jobs that are being created, and there have been a lot of jobs created, but the jobs that are created are more low income, minimum wage. We're getting a one-time lift with this movement up for the minimum wage, and perhaps in some markets it'll even go to $15 an hour. That will have a significant impact. But overall, wages are not increasing, and the number of jobs in sort of that middle range, which is what sort of the middle income America had lived on, those jobs which were very much in the line of manufacturing and are now kind of low-end service jobs, those prices, those job incomes don't seem to be going up at the same rate as housing. And so, and this moves me into my next thing I wanted to talk to you about, which is that all of the new reports are showing the number of renters between now and 2030 increasing dramatically over the number of new home buyers who are out there. So you end up in a situation where maybe as many as 77% of all households created will be renters instead of buyers, particularly important in that millennial group. How does that factor into what you're going to see in terms of home valuation?
I think the demographics are fascinating right now, Elise, and I'm glad you brought up the millennials because we've seen some very important developments among that cohort just recently. One thing that I think is so interesting about the millennials, and it might be related to the fact that the labor market was just so lousy the last few years, is that many of them stayed in school and actually completed a college degree. The millennial cohort, by educational attainment, is the most highly educated cohort that we have seen enter the housing market. There's a larger percentage of the cohort with college degrees, and that sets them in a good position for forming households and for progressing into home ownership at a later date. Not now, probably not the next few years, but at a later date. The average age for a first-time home buyer has edged up, and it's more like about 30, 31 years of age. And the millennials are a really big cohort. In fact, the number of people by single year of age in the U.S., the largest single year of age of population are those folks who are aged 23, 24, 25 today in the U.S. So that's the key ages for forming households, moving out from relatives, from parents, and they'll start off in the rental market, and that's why I agree. The outlook for the rental market is going to be very strong the next few years, but they will transition into the home ownership market at a later time, and I think the outlook for the home sales market over the next several years is actually pretty positive.
Well, it'll be interesting to see. I don't know. The Urban Institute just released its latest numbers, and it shows that, I want to say, something like 9 million people between now and 2030 are going to be buying a home, and something like 20 million are not going to be buying a home. They're going to be renting. And millennials, I know that realtors and home builders are desperate to have more people buy homes. but it just really seems to be that it's going to focus on this rental market. Doesn't mean that real estate agents won't have anything to do. They're going to be buying and selling property for people, but it's going to be more investment property to investors rather than anything else. It'll be interesting to see how this plays out over the next 15 years, but the trend right now certainly looks to be that 31, which is, as you point out, the average age of buying a first home, may jump up to maybe 35, 37. And that is as life expands, right? So we don't, you might live to be 100. Maybe buying your first home at 37 is a good thing.
Yeah, well, and that may very well come to pass. I think one of the really interesting trends that you were underscoring, Elise, was the fact that we have seen a large part of the single-family detached housing stock move from owner to rental over the last 7 years, since the peak and during the bust of the housing market. So agents may be selling more investment or rental houses going forward. It's very interesting. The number of single-family detached houses that were in the rental housing stock increased by almost 30%. It increased by about 3 million houses between 2006 and 2013. So there's no question there's been a big shift in that direction.
It'll be interesting to see how that shifts back and if the millennials and younger people ever realize that when you're renting, you're paying somebody else's mortgage for them. And when you own, at least you're paying it for yourself. We'll see if they figure that out. Frank, thank you so much for being with us today.
Thanks for having me, Elise.
Frank Nothaft is the Senior Vice President and Chief Economist at CoreLogic. Thanks for watching this episode of Big Money Real Estate. As always, you can send me your real estate investing questions on Twitter and Facebook. Please share this video all around with all your friends on social media. And don't forget to check out my brand new series, The Intentional Investor, How to Be Wildly Successful in Real Estate. And you can find that at the Wit Nation store or at thinkglinkstore.com. See you next time. I'm Elise Glink.